Hey, what's up, guys? It's Goose back with another Sunday watch list. Just here looking at some data. I wanted to change it up a little bit. I know usually I go straight into the charts and start, showing you what I'm seeing for the week ahead on stocks. I wanted to give you a little fundamental analysis too. So a lot of this that you're seeing is technical analysis. That's on the chart, looking at supply and demand zones, support resistance, stuff to that nature, trend lines. That's all technical analysis. Fundamental is what's happening with the data that we're getting. So typically, fundamentals do play a role in the economy, but like most know, is the stock market is just kind of a reflection of the economy. It's not the economy. So when things are bad in the economy, typically you see the stock market come down, but what's happening is right here, this big old downtrend in the technical analysis aspect, this was from the Federal Reserve raising interest rates. And when they raise interest rates, it usually leads to, um, where'd it go? Oh, it will cause earnings to fall and stock prices to drop because businesses and consumers will cut back on spending. So when you see in the charts that it's coming down drastically, that's more of kind of I wouldn't say a guess, but just an assumption from Americans that if you're raising interest rates, earnings is going to go down and the economy is going to slow down, jobs won't be there. So this big sell-off that we had in 2021, 2022, it was due to the Fed raising interest rates the fastest they ever have, in 40 years, 60 years or something like that. And when that happens, typically what they're trying to do is lower inflation, and because inflation was going up and things to that nature. So as we're getting the sell off, people are saying, oh, inflation's this high, but we still have interest rates this low, so you need to raise quicker. And as they're raising, people don't like that because, like I showed before, it typically leads to losses of jobs, losses of earnings, and earnings are big with the stock market because when Apple reports and stuff, it matters on if they're continuing to grow, if they're continuing to develop. And with them raising interest rates, trying to get inflation down, they are accomplishing that. Like I pulled this up. This is the CPI, the consumer price index. So as you can see in like major categories, we are at 3%. We maxed out at 9% on CBI. So what we're starting to see is things starting to come down. We have food still up there a little bit. It's mostly in energy that you see it coming down. Fuel, oil, 36%, 26%. Apparel, that's still going up a little bit. We got used cars, trucks, those are coming down a little bit. So with the Federal Reserve raising interest rates, they're trying to slow a lot of this stuff down. The consumers, what are they buying? What are they getting into? So they're slowing it down. What the Fed has kind of spoken on before is that they're trying to slow down the labor market and just a little bit to soften up, conditions. And this is GDP. So this came out last week, I think. Jimmy said, one of the other admins in the Discord, and GDP went up. I think it was 3% even or something like that. Or right here it says, yeah, it went up zero point 0.4 from the first quarter, and now in quarter two it went up zero point 0.4. GDP is basically it stands for gross domestic product, and like right here it says what is measure of U.S. economy activity. GDP measures the value of the final goods and services produced in the United States without double counting the intermediate goods and services used. Changes in GDP are the most popular indicator of the nation's overall economic health. So, like I said, the stock market is not the economy. It reflects it. So what the economy is doing, typically stocks are going to follow. If it's going up and everything's good, people are going to be buying stocks and companies. But if the GDP and we're starting to produce less, that's typically what shows that we're getting near like recessionary areas. So with kind of like the starting thing is what I'm saying, and from a fundamental standpoint, you have to understand that the Fed was trying to raise interest rates so everything came down because people were scared. But what people are starting to see is in CPI, it's coming down. It's close to 3% when it was at 9%. So they're accomplishing their goal in the fact that our unemployment is the lowest that it's ever been. Interest rates are higher, so the economy's starting to slow down. CPI is coming down. Their goal is 2%, so they're still a percent above that, but people are still seeing we have jobs. People are still spending. People are staying afloat. The houses are staying the same. So what majority of this rally was due to fundamental data coming in and showing that you know consumers are staying strong through a high interest rate environment. Earnings are coming in. All the some major techs and stuff are still beating. No one's really like losing a bunch of money, and like once you see earnings coming in and they're beating them, it's like you don't really have to you know, worry if the economy's healthy. It's showing you right there that businesses are still able to beat it even with the high inflation, high interest rate environment. So a soft landing is kind of what they portray it and what they call it, and that's kind of what's happening here. Is right now the economy is still looking good and interest rates are higher. So there was fear here, and now there's a little bit of hope, and people are starting to get it. And then you play the technicals, the trend lines and stuff like that. But most of this push is due to fundamental aspects, like the economy is still looking good, even though interest rates are very high, so and CPI is coming down. So it's hard to argue the data there. But I haven't really had much time to look at charts, so I was just kind of going to go through it with you quickly. The Qs, they bounced off that level that Jimmy and I were calling out during the week. It's right around here where this gap fill is supposed to take place. As you can see, it bounced off there, and then it came down, had that falling wedge that I posted a few weeks ago, broke out of there, and then it came back down, retested it, bounced off, went all the way up, came back down, filled the gap that it had, it bounced off. So it's showing strength. It's not wanting to go down, and it's still going up. I did have a video last week where I was saying I don't really see much of a point in calls. It's still kind of in that area, but there's definitely some topish like vibes that I'm getting. Like it seems like a lot of people are just kind of scared to continue to pile in. But you have to be realistic. Is like look at how close we are to all-time highs. I mean, we are not very far off percentage-wise. We're about 6% on the Qs. The S&P 500 I think is within like 6 or 7%. Yeah, 5% from all-time highs. So now when you're that close, it's almost inevitable, especially since we entered a new bull market. I mean, there's data that shows once you enter a new bull market, I think it's close to like 3 months. Within 3 to 4 months of that bull market beginning, there's usually a pullback. And that's kind of what I've been preaching a lot is like some of these trend lines that are so far like straight up, like I'm waiting for something to break here. And it's not that I'm like sitting on my hands not playing calls when it does bounce, but I'm also well aware that we are kind of in the extended side and interest rates are still high and the Fed still kind of has their foot on the gas trying to bring that last percent down. So that with the technical side of it, SPY's still bouncing off this trend line until it's broken. I wouldn't panic. Last week we saw it come down drastically, but it's still holding that ultimate trend line until it breaks in the downside. You can't really short anything like that. Bitcoin was one that I did call out a few weeks ago, and I think when it broke out last week, it did break in the downside over here because it was holding this trend. So that's something I'm watching. As long as it doesn't reclaim the I don't know, 29.5 area, then I think there still could be some shorting action, some selling action. Another thing to note, we do have some big earnings. We have Apple coming up this week. We have AMD. I believe Amazon is doing it too. But these trend lines I'm talking about are something like this, where it just continuously goes up until it's broken in the downside. I mean, you can't really short it. I mean, it just keeps going up. It keeps getting eaten up. This is from January 3rd, 2023. This is a lot of time where it just continuously goes up because shorting is just going to destroy you on something like this. So just be careful with that. UPS, they are getting closer to the top end of the trend line. I was calling it out somewhere around here where there's a major support. It does seem to it got up there, tried to make the break, but it didn't quite make it. So we're gonna see what happens. I personally just root for UPS because I work for them, so I'm always looking for them to keep going. But this wedge is interesting to see what happens. This is on the daily, so the break is going to be massive in the up or the downside. The one that I wanted to point out was Boeing. I called that one out last week, the last 2 weeks, because of their consolidation happening. It finally did break out. So, as I said, there is pretty big earnings coming up, so that can kind of violently move the market. But if it can hold above, the 220 area and it does have some sort of a pullback, I still think calls are very valid because you have to think of how long this was in consolidation. The move is going to be massive. The next sort of resistance would be right about the 250 area. So I think I would look for calls within 250 to 230, 220, somewhere in there. That sweet spot of about $30, and then see what happens. But that's a pretty telltale sign that that's probably going to continue to go up as long as the market reaches it. Meta, they had earnings last week. So they, I think, uh, beat, and everybody was excited. They were up close to 6% from this area. Sold off kind of midday. Everybody's thinking gap fill, and then got smoked the next day after the FOMC meeting. Just continue to go up. Big tech has just been unstoppable. I plotted out those two gap fills that could potentially happen in the downside, but it's the same thing. Anything, not below 280 area, depending on how high up it gets, 300. If it's not broken below that, I'm not looking at shorts at all. I mean, it can just keep going. Netflix, I've been kind of watching them. They still haven't gotten above the major resistance at 450. If the market does slide, I've been looking at them as possible shorts, probably somewhere around the 360, 375 area, because there is a gap right here. It's hard to see, but there's a tiny gap. Let me pull that up. Where'd it go? No, no. Sorry, sometimes I forget where some of these tools are. It's just a small little tiny gap, but it's something that could accelerate the selling speed if it does continue to get smoked. It has a good little base right here. This is the daily, so this is even right here, the small amount or a good amount of time. So you have a buy right here, 415. You have a buys right here, 415, and that's exactly where it's landing. It's holding those spots. Tesla, Jimmy and I had the break of it because this candle right here was breaking the ultimate trend that it had. But like I said, after that FOMC sell off, the next day it kind of came up, because we had big earnings and they were beating. So a lot of people are still bullish, still trying to keep the momentum going. This is still a cause for concern if it does come up. I don't know if it can break that ultimate trend. I let you see the big picture. Usually, once it comes up here, it's going to make another leg lower. But if it does break anything above that, I mean, it's gone. See a Tesla at 500. Love you, bud. Shopify, still the rising wedge that it's got going on. Watching this trend line, there's a huge gap below with a lot of these like stocks that I'm showing. There's gaps below, but their trend lines are still up. So it's like you don't want to battle the trend. You don't want to start shorting, just in hopes that a gap fill will happen. You want to watch the trend lines and make sure that they do break and stuff like that. Costco, still have the break of that, continuing to go up. This is why we watch those trend lines and we watch the coilings because, as you can see, it breaks, it retests, and it's gone. It's like that's easy money right there, dude. Really easy money. Cleanest one I've had in a while. ARC is still trying to do a little bit of the W. I mentioned last week you want to wait, not really wait, but you want to just watch the 50, 52 level up here. It's like it can go up there, but if denied, it's going to look bad. So you kind of want the confluence of a breaking resistance for you to get into calls, maybe 60, 55, somewhere around there. Nvidia, gotta show Nvidia. They're just keep going, can't be stopped. Kind of looks like Shopify, the rising wedge that it's got going on. Shopify has a gap below as well. I'm watching kind of this resistance area right here. I think if it breaks above, it's probably going to break out of the rising wedge. But we have earnings this week on AMD. It kind of looks the same thing. There is a gap. Looks like the gap is already filled actually. but it's coiling up. I mean, you can see the little flag. There's a pull right here, and then pull this down, pull that down, and you got something to work with. You got a little analysis, little flag, bold flag pattern. So it's like a broken above that is 120 area. It's gone. 140 maybe. Broken below, maybe you could break the 100 level, go 75, not 75, 80 to 100, somewhere around there. So you just got to keep watching it. As you can see, I still have old charts of when it's breaking out, but it does the same things. I mean, you watch the coil, you wait for it, it breaks out, it goes up. Then you have this major downtrend. You see it just bouncing off, collecting itself at the bottom of it. Once it breaks, there it is, making a new trend. This was a downtrend, this is an uptrend. And it's like you could see that in some of the consolidation areas. So that's about it that I had for you guys. I thought I would switch it up and throw a little data out there. It's called fundamental analysis. It's usually when you get into the numbers and earnings crunches and stuff like that. It's a little different than exact just looking at buy and sell points on the charts. But maybe I'll start